Welcome to the Steps to Investing podcast, helping aspiring investors get to grips with the world of finance and investing. On today's pod, Tom Selby from AJ Bell, the investment platform, talking about forthcoming changes to pensions and a new tool to help investors get the best from their pension after retirement. And we look at investment scams and tax limits. Hello, I'm Simon Longfellow.
And I'm Marcus De Silva.
And welcome along to this week's podcast. Marcus, what has piqued your interest this week in the world of investing?
Yeah, it's a couple of bits of data. That's how exciting my life is. And the first bit was having a look at the money that's going in to funds in March. Okay, this is fund flows, as it's called in the industry. And UK private investors have been pretty excited. They've been piling into the markets. In fact, they set the record for the best ever March, which I thought was quite interesting. And where they've been putting their money is mainly equity funds. So that's funds that invest in shares. We saw £2.96 billion in net new money in March. So that's when you account for outflows as well. And it seems not only that, but we're on side with actively managed funds, right? So we are actually quite liking the idea of having a fund manager overseeing what's going on. So out of that 2.96 billion, 2.32 billion of that was in active funds. So we're liking active over passive. And of that 2.32 billion, 2/3 of that went into global funds. So I think what investors seem to be opting for is some quite broad exposure to the recovery, really, which makes a lot of sense. Other flavours also make quite a lot of sense. So UK shares have been quite popular. We know that from what Ben Seeger-Scott was saying, UK indexes and markets are quite attractive at the moment for investors because we had this big period of Brexit uncertainty, which created some pent-up demand. And then, of course, we had the pandemic, and with the UK index being quite globally exposed and also quite economically sensitive, it pounded it on the way down. But in terms of the recovery, and especially since we heard news of the vaccines, and there's been more of this value trade, suddenly the UK market is looking a lot more attractive. So that makes total sense. Also, the other one makes total sense. ESG mandates are pretty popular. So sustainability mandates. And that's kind of what we expected, really. So that I thought was all very interesting. The second bit was some data from Interactive Investor, which had a look at the average portfolio of their ISA millionaires, which is obviously a goal we all want to get to, right? We all want to be an ISA millionaire at some point. That would be really, really nice. And what they were looking at was the types of investments that these ISA millionaires had in their portfolio. What do you reckon, Simon, was number one?
This is a tricky question. I don't know. I mean, I would guess it's individual shares in individual companies and maybe smaller companies, but it would be a massive guess.
That was actually number two. So you are incorrect there. The number one, over 50%, it's 54%, was in investment trusts.
Really?
Yes. Which, yeah, you would think, okay, if you're really gunning for some really punchy returns, then maybe you might have gone for more single stock positions. But actually, I think it's the geared nature of these returns that you get from investment trusts, plus some really cracking ones out there. I mean, when you look at the top investment trusts that they've been buying, it's all the usual suspects, right? So Scottish Mortgage, Alliance Trust, Witten, City of London, RIT, these are the ones that are sort of the big ones. So, it points to something good there. I mean, we're very positive on investment trusts, having worked with them. But, when you see stuff like this, it sort of adds to that evidence. And in case you are wondering how much you need to squirrel away and what you need to earn to become an ISA millionaire, if we assumed quite a conservative rate of growth, I thought, at 5%. I think that's quite conservative. It's possible you could get much higher than that. But year over year, if you manage to get 5% out of your portfolio and put in your maximum that you're allowed to each year, assuming it stays the same, so £20,000 per year, then you'd be an ISA millionaire after 25 years. And you would have invested half of that. So 500k would have been invested, and you would have over £1 million, just over £1 million in terms of value if it had grown at 5%. So it's not a crazy unimaginable goal, actually. I mean, £20,000 is quite a lot to put away each year, but that's how you kind of get there. So I thought that was quite interesting. Simon, what about you? What have you got?
Well, it is interesting, actually. I was just thinking, because, of course, ISAs have been around now for late 90s,
Yes.
wasn't it, when they arrived.
Pets,
so,
wasn't it?
over quite a long period of time, these guys have obviously been investing. Anyway, what have I been looking at? Well, I've actually been looking at platforms, oddly enough, investment platforms, just as part of some work we're doing that we'll be launching on the website later in the year.
Brilliant. What have you found? Have you found anything interesting with platforms?
Well, I mean, the first thing I say, I don't want to be negative, but I'm going to be, is that they don't always make it easy when you're trying to find basic information. I was looking for things that I thought that would be, useful to know for people considering opening their first account. Sometimes it's actually quite hard. I'll give you an example. Flexible ISAs. So these were introduced pretty recently. They allow you to take money out and then put it back in again to your ISA without it counting against your £20,000 annual limit. £20,000 is currently. So that's a pretty neat feature, right? And if I was running a platform, I'd be making a sort of reasonable song and dance about offering it, because actually not very many people do. But bizarrely enough, it tends to be sort of hidden away in the small print, which I find just a bit odd. On a more positive note, the other thing that struck me, having looked now probably about 20 of the sort of leading DIY platforms and also the digital wealth manager ones, it's just the sheer variety of services available, and of course the different charging structures and different price points, as they call it in the jargon. There literally is something for everyone, and with a bit of digging, you should be able to find a service that suits your needs. As I say, more on this from us later in the year.
Yeah, we thought with the flexible ISAs that part of that is actually a technological reason. It's quite hard to administer that sort of fluidity, I suppose, with your ISA allowance and stuff. So might be something that changes in the future.
Yes, I mean, quite possibly, as the back end systems for a lot of these platforms are actually provided by a pretty small number of companies, and as they roll out these things, that should become available to more people, you would have thought. And as I say, I think it's a really interesting feature that is actually very helpful. Okay, well, in a moment, Tom Selby from a platform, AJ Bell, he's talking about pensions changes and investment scams, amongst other things. First, let's catch up on what's been happening this week in the major stock markets and with the companies trading on them. Marcus, markets.
Yeah, I'm strong, very strong at the moment, really. Markets, it seems, and this run really with more economically sensitive names still seems to be going. In Europe, Wednesday broke through all-time highs, as we saw Fed minutes that showed that the central bank in the US is still feeling cautious about the recovery, so going to remain very supportive in their monetary policy. So that means things like, keep buying bonds at the enormous rates that they're buying them and keep interest rates low, all that kind of stuff. So all very supportive for the economy and for markets as well. So that's causing markets elsewhere in the globe to do quite well. And as I say, Europe broke through its all-time highs on Wednesday, which is pretty good. And that included those economically sensitive names, so in industries such as mining, car making, retailing and the like. Thursday, though, bonds prices rose a little, showing a little bit of a pullback, really. And that's to do with the emerging data from this link between AstraZeneca's vaccine and blood clots, which is causing some worries as to whether it will hobble what is already quite a slow vaccine program in Europe. Italy and Spain have now said the AstraZeneca vaccine will only go to the over 60s. Of course, there are other vaccines, but this is one of the major ones. And, as I said, it's quite behind in its vaccine programs. The UK and the US are much further ahead. They expect to achieve herd immunity by the end of this year. The EU is nowhere near that now. And then on top of that, it's facing fresh lockdowns and surging viruses. So, yeah, that's put Europe back a little bit on the back foot. In the US, Biden is talking more about his $2 trillion proposed infrastructure plan, which of course he still needs to get through the houses, but its target was to raise corporate taxes from 21%, which had been reset in Donald Trump's era in 2017, up to 28%. But he signaled he will negotiate. So it doesn't seem like there's going to be this big protracted battle with the corporates, really, and it will probably settle at around 25%. In the UK, there's quite a lot of positivity around economic reopening off the back of our pretty advanced vaccination program, which is really great. It's causing those economically sensitive stocks to continue to rise. We're also seeing a bit of a weaker pound helping some of the big FTSE 100 players who have overseas exposure in their revenues. So it's something like 70% of the FTSE 100 derives its revenues from overseas. So if you get a weaker pound, then you'll see a bump in earnings as that translates. So all in all, the S&P 500 is up 112 points to 4,079. The FTSE 100 is up 137 points to 6,912. The Euro Stoxx 600 is up 5 points to 436. And the Nikkei 225 is up 24 points to 29,708. Simon, what's going on in companies?
Well, first up, some news from the investment industry, and specifically the world of exchange-traded funds, or ETFs. Now, these are the funds that don't have a fund manager, and they're basically set up to track a basket of shares. Well, one of the big players in this space is a company called Amundi. They're based in Paris. And it started talks this week to buy a company called Lyxor, which is another key player in the ETF space. Now, the deal itself would be worth 77 billion euros if it goes ahead, and it would make Amundi the second largest player in the whole of the ETF industry. Lyxor, in case you didn't know, it's owned by Société Générale. It will also sell 47 billion euros worth of actively managed funds. So these are the ones with a fund manager, again to Amundi. The deal, it's come after 18 months of speculation on the subject and, of course, is subject to regulatory approval. Moving now to online fast fashion, and ASOS has announced its results for the last 6 months this week, which show it has been a huge beneficiary of the virus-enforced lockdown. In the last 6 months, it added 1.5 million customers, which brings the total to just under 25 million. Sales were up by a quarter in the same period, profits up to £106 million. The firm also announced that there'd been a shift in the kinds of things we're buying from them, so not so much around going out clothes, but more kind of sports clothes and casual wear. And it also said that its integration of Topshop and the other Arcadia brands, which we reported on earlier in the year, that's going well, progressing to plan, is what they are saying. Finally, some much needed good news for shops and businesses on the UK high street this week. Research analyst Springboard has said they reckon there'll be a 50% jump in sales when the lockdown restrictions are lifted on the 12th of April, all just due to pent-up demand in the system. It also reported that footfall in shops in central London was 3 times greater over the Easter weekend just gone than for the same period in 2020. Springboard says the fact that there are more consumers visiting these locations to buy from those essential shops which are allowed to stay open indicates this pent-up demand to make shopping decisions in person in the bricks and mortar stores rather than online once we're allowed to do that. Okay, that's it for companies. Earlier today, Marcus spoke to AJ Bell and Tom Selby there and got under the skin of pensions, some changes that are forthcoming, and new pathway tool for what happens when you retire.
Now, pensions are, of course, one of the main ways we invest in the markets, and many times we've discussed the fantastic tax incentives attached to them. It's also a rapidly evolving landscape as the government continues to push pension responsibilities onto us. The past 10 years, we've seen some pretty radical policies go through, such as auto-enrolment, pension freedoms, and changes to the state pension age. So, to get us up to date with the latest pension developments and how they affect us as we begin this new tax year, I have back onto the pod Tom Selby, who's the pensions analyst from the UK's second largest investment platform, AJ Bell. Tom, a very warm welcome to you.
Hello, Marcus. Thanks for having me back.
It's good to have you. Firstly, let's start with the budget on the 3rd of March. Was there anything that Mr. Rishi Sunak said?
Oh, it feels like a long time ago already, doesn't it? The budget
does,
only just over a month ago as we're recording this, and there was a little pensions nugget in there from Rishi Sunak. Unfortunately, not a positive nugget for people who are saving for retirement. Obviously, the backdrop to this budget was very much coronavirus and the huge black hole that it's gouged into the public finances. I think just over £300 billion extra borrowed by the government as things stand versus what it was expecting to borrow, and that borrowing obviously to pay for the furlough scheme and various support packages. And so I think that the Chancellor felt the need to put a bit of a stake in the ground in terms of working out how to pay off some of that extra borrowing. And one of the measures that was announced was a freezing of the lifetime allowance. Slightly irritatingly, from a purely having round numbers perspective, we don't have a round number. So the lifetime allowance is just over £1 million. So £1 million and £73,000 and pounds and 100. Does that sound about right? 1.073,100. Difficult for me to say, but that's what the lifetime allowance is going to stay at between now and 2025-26. It was supposed to be going up in line with inflation, so in line with CPI inflation. So a bit of background, I suppose, useful to the lifetime allowance. So that's the amount that you can build up over your lifetime in retirement savings. If you exceed the lifetime allowance, then a charge will be levied on that excess amount, which will take back the tax relief that the government's given to you. The lifetime allowance has been changed loads of times over the past decade. So back in 2011, it stood at about £1.8 million. It's been salami sliced down, went to as low as £1 million before this inflation link was introduced, which we hoped was going to bring a period of stability. Of course, we now don't have that. So we had a look at what the lifetime allowance would have been had the CPI link being kept in place, and it had kept on rising as we thought. Lifetime allowance would have been about £85,000 higher in 2025-26 versus where it's going to be now. So it's just another thing that people need to navigate. It's probably worth pointing out it's not just something that affects older, wealthier pensioners. I've seen it characterised in that way. In fact, freezing the lifetime allowance is going to constrain the ability of younger people to build a decent retirement pot, probably more than older people. Older people will have tended to already turn their pension into an income, and so are more likely to have benefited from one of the older, higher lifetime allowances, whereas it's people who are saving for retirement at the moment, and particularly those who make good contributions and enjoy strong investment growth, who are going to be hit by this freeze. And I think more broadly, one of the challenging things with this constantly changing pensions tax framework, it makes it very, very difficult for people to plan. So you've got a lifetime allowance that has been 1.8 million, and then was 1.5 million, and then was 1.25 million, and then was 1 million, and then went up with inflation, and now isn't going up with inflation. It's quite difficult to know exactly what your limits are because it keeps on changing. So that's just another thing for people to navigate, and something that people will need to think about as they're saving and investing for their future.
Because it's confusing. It would be so much easier if there were just limits on contributions, and then whatever the portfolio performed was, down to how well you selected investment. That would be much easier than having this figure, which, you hope to get to, but you might undershoot, you might overshoot. It does make it more confusing in that sense. It's
a real challenge, and there have been various lobbying attempts made by a number of organisations to the Treasury to try and get rid of the lifetime allowance. It's something that we've pushed for before because, as you say, partly because it punishes investment growth. It obviously acts as a disincentive to save, but as you say, you've already got that annual allowance in place to control spending, which is fairly straightforward and easy to understand. And I think people sometimes struggle with the idea that purely by having good investment growth and doing the right thing and making investments and making contributions, all the rest of it, they could end up breaching this lifetime allowance. And some of the most complicated parts of the pension system exist because we have a lifetime allowance. And if that were removed, then it would lead to lots and lots of simplification, which is always a good thing. But unfortunately, it looks like it's here to stay and at a lower level, at least for the time being.
Yes, because just as a reminder, and am I right in saying this, Tom, is 40,000 per year is also your limit into how much you can put into a pension, right?
So that's the annual allowance. A few minor caveats around that. So if you're very wealthy, so if you've got earnings of above £300,000, then you might be affected by the annual allowance taper, which means that your annual allowance may be somewhere between £40,000 and £4,000. That caused a lot of consternation among doctors in particular a couple of years ago, because people who were working longer shifts ended up being caught by this annual allowance taper and paying an extra tax bill as a result of it. So that's one slightly different annual allowance that people have to navigate. And also, if you've accessed taxable income from your pension flexibly, so if you've gone into drawdown, for example, and taken taxable income from your fund, then that triggers the money purchase annual allowance, which reduces the annual allowance from £40,000 to £4,000. But for most people, provided you've not got a very high income, and provided you haven't taken taxable income from your pension, then the most you'll be able to pay into your pension is £40,000, or 100% of your earnings for the current tax year. And again, not as simple as you would hope it would be, but for the vast majority of people, it'll either be 100% of your earnings or £40,000.
Are we going to see any more radical pension changes down the road? Is there rumours of anything like that?
Yeah, always rumours of radical pension tax relief reform, as I'm sure you know, and I think we'll hear more rumours of such reform as time goes on. We certainly before most budgets I've covered, frankly, there've been rumours that higher rate pension tax relief could be for the chop. I think for any chancellor looking at the nation's finances, whatever the financial weather, the net, it's around £40 billion altogether, all in, that's spent incentivising people to save for retirement when you include employer national insurance relief and things like that, as well as higher rate relief in the calculation. Clearly, any chancellor who looks at £40 billion a year will be tempted to look at ways to change that. I think, as I said earlier, when you're looking at an economy that's been battered and bruised by coronavirus, then clearly the Chancellor is going to be keen to make savings where possible. So I think it's inevitable that the Treasury will be looking at things like higher rate pensions tax relief and whether that can be reduced, or perhaps a flat rate of pension tax relief introduced somewhere near the basic rate, which would potentially save the Treasury lots of money. Whenever this topic comes up and whenever these conversations are had, the challenge and where the rubber really hits the road, I think, for the Treasury are both in terms of the practicalities and the politics of doing it, usually actually for defined benefit schemes rather than defined contribution schemes. So I think for defined contribution schemes, the practicalities are relatively straightforward, because it's just a pot of money, and the money's usually coming out of people's salary. And I think that could be done reasonably straightforwardly. It's when you're looking at a salary, defined benefit pensions are paid via salary sacrifice. It's not clear how, when you've got a salary sacrifice scheme like that, how you would introduce a flat rate for somebody who's already a higher rate taxpayer. So how you would make those two figures align. I suspect you would need to have something which would adjust the tax codes of defined benefit scheme members, and what that would lead you towards would be essentially doctors, NHS staff who benefit from generous DB pensions being hit with a tax charge from the Treasury in a year after they've been the people on the front line dealing with coronavirus. I think that's where the problem's really going to lie in terms of moving from a Treasury potentially being keen to do something like this to Number 10 actually signing it off. I mean, and then of course you've also got the problem that the heartland Conservative voters are the kind of people who will benefit from higher rate pensions tax relief, and who would kick up, I think, a bit of a stink if the government moved to change that.
Okay, well, let's go on to the Pension Schemes Act, which has had an update, and it's turned into law from a bill by the Royal Assent in February. So what's happening here? What is it trying to do? Because it's quite wide ranging, right?
Yeah, it's a big piece of work. So two years of legislative time taken up creating the pension schemes bill and then getting that bill through Parliament. So on Twitter, which isn't always the best source of information on bills and acts of Parliament, but nonetheless, the DUP tried to break it down into 3 words. They say that the Pension Schemes Act will make pensions safer, better, and greener. Now, obviously, it does that. That's attempting to break down quite a few thousand words into 3 words. Not always the best way of doing it, but I suppose one of the key elements of the Act in terms of making pensions safer is around new powers for the pensions regulator. So the shadow of Sir Philip Green and BHS looms large over these proposals, and so what they're looking to do is introduce various new powers for the pensions regulator to stop another Philip Green and BHS situation happening again. So new criminal offences in place and new fines of up to £1 million for employers who fail to meet their obligations to pension scheme members. Those criminal offences ranging from avoidance of employer debt, conduct that puts at risk the accrued pension, DB pensions of members, knowingly or recklessly providing false information to trustees, various other measures in there, essentially trying to stop another case where a company like BHS is sold for a song by its owner to a new owner who doesn't look after the DB pensions of those members, and those members ending up getting lower pensions as a result. I think if you were being critical, you would say that this is a classic example of a government introducing rules after the horse has bolted. Clearly, you can't stop BHS and Philip Green happening because it's already happened. But I think there are still lots of companies, lots of FTSE companies indeed, who've got big defined benefit deficits, who'll be potentially considering merger and acquisition activity, who'll be thinking about what they're going to do in relation to that DB scheme. And I think the fact that they've got these new powers in place is going to push the fate of DB pensions close to the top of the corporate agenda whenever deals like that are being made. And I think that's the point of these measures. I think it's possible that the extent of the powers will end up being tested in the courts of the land. That's quite often the case when you get new rules like this in place. But it's a pretty clear signal to any company that's got historic DB scheme membership, and that's mostly what this is now, historic DB pension liabilities, that they need to make sure that they're giving those pensions that the focus that the government now deems that they deserve. So those people's pension.
I was just going to say, will they prevent companies being sold if they've got big pension liabilities? Is that what these will do?
They shouldn't prevent them being sold, but it's more likely that a company will have to have a very specific plan in place to make sure that the pensions of the members are going to continue to be looked after. So whether that's the company that's buying a company that's got a big DB deficit taking on those liabilities altogether, I think we'll probably see a lot more companies entering insurance buyout or buy-in deals, so where their DB liabilities are sold to an insurance company which agrees to pay the pensions to members. I think we'll see a bit more of that activity, because I think, frankly, most corporations just want their DB responsibilities off their balance sheets. Defined benefit schemes generally are something of the past, except for in public sector schemes, of course. I think they were entered into by companies based on projections of life expectancy and things that haven't, and projections of interest rates and what was going to happen to the economy as well, that haven't necessarily turned out how they expected, and as a result they've ended up being a kind of millstone round their neck. So I think a lot of companies will just want to get rid of those liabilities where possible. A lot of those schemes have closed to new members anyway, but certainly where a corporate transaction's taking place, or where any companies thinking about doing things in relation to the structure of their company, they'll have to put their scheme members front and centre, or face a newly tooled up pensions regulator potentially coming after them.
Yeah. We also pension dashboards. What's happening with those?
Yeah, pensions. I mean, I feel like I've been talking about pensions dashboards for about the past 40 years, and I think it's a classic thing. This project. I think it was 2016, 2015, 16, maybe, that pensions dashboards were first mentioned as something that was necessary. So the thinking behind this is to allow people to see all their pensions in one place online, and with auto enrolment, which you mentioned at the top of the programme. More people are going to be building up individual pension pots, and with an increasingly transient workforce, I think it's somewhere between 9 and 11 employers people tend to have throughout their careers, as the potential for people to build up individual pension pots with lots of individual pension within employers. And it's difficult to track all those. So pension dashboards aiming to deal with that problem by allowing people to see their pensions all in one place online. It's a really difficult project to get off the line. I think more difficult potentially than the DWP recognised when it first came up with the idea. So they first suggested they were going to try and implement pensions dashboards in 2019, and now looking at 2023 to do that. So the Pension Schemes Act enables the pensions dashboard to be built in the UK. A lot of the details are still to be ironed out. I think we'll get a lot of the details in the secondary legislation, as is often the case with stuff like that. So things like how people have to provide the data security, regulations that will go with dashboards, how information is going to be presented to members. All this stuff still needs to be worked out, as does the onboarding process. So the order in which different pension schemes will have to provide data to pensions dashboards. So we hope that we'll get to a place where all different types of pensions information will be available on dashboards. We think that's the only way that they can really have legitimacy. I think people will want to click on a dashboard and be confident that the number they see is all of the pensions that they have and doesn't have any missing information. And so that's part of the complexity in doing this, is that you've got all these different kinds of pensions that have been built up throughout history. I think sometimes I think both the DWP initially and perhaps the wider industry underestimated the size of that challenge. When you think of defined benefit schemes of various different employers, some of which may have okay systems, but some of which will effectively be operating on spreadsheets. You'll have old closed book insurance providers, which will likely have quite antiquated systems as well. And you've then got more modern platforms like AJ Bell and others, which are very tech focused, and for whom this kind of stuff is kind of more day-to-day and probably quite straightforward. But you've got to hook all those things up into one thing where you can put your data in and know that the information that comes out is accurate, and there's no risk of that being infiltrated by scammers and all the rest of it. So the Act means that dashboards should happen. We should be getting them in 2023. It's just a question of working out the nuts and bolts, which has been done by various working groups at the moment.
Well, you mentioned scam. That's a good segue into my next question. We've got some new proposals, haven't we, from the Department of Work and Pensions on trying to prevent some of these scams. Because I saw another story the other day. It was Martin Lewis was talking about someone had impersonated him, and a scammer had managed to get someone to transfer their pensions. And it's so tragic because it has such a massive impact, obviously. So what are they proposing in this area?
Yeah, so unfortunately, what they're proposing it's not gonna solve the problem with scams, but it could potentially be a step in the right direction. So the government wants to introduce a new red flag warning system when someone puts in a request to transfer their pension. So these were proposals that came out alongside the ban on pensions cold calling initially, which was got a good 2 and a bit years ago. Just shows how long it takes for this stuff to end up coming into legislation and eventually end up being enacted. So the idea is that when somebody is transferring their pension, where there are certain suspicious actions detected by the provider, additional questions and due diligence need to be asked to check that the scheme receiving the pension is legitimate. If those questions aren't satisfied, then the provider will have the right to block the transfer. So previously, the ability of providers to stop people from transferring was constrained because people have a statutory right to move their pension from one scheme to another. So potentially a useful deterrent to scammers, a useful extra power for schemes. I think the challenge here, two challenges I'd say here. Firstly, the vast majority of scams that we deal with now, and I think that are prevalent in the market now, aren't within pensions anymore. They're outside of pensions. So you mentioned the pension freedoms in 2015, the ability of people to access their pension, their money freely, and spend and potentially take all of their money out of their pension if they choose to from the age of 55. As a result of those reforms, we've seen scammers move almost all of their activity away from trying to get people to move into, for example, liberation schemes, which allow you to access your pension early. They've moved away from those kind of models and to models where they're trying to convince people just to take their money out of pensions and invest it in a Bitcoin scam or in a crypto scam, not just cryptocurrencies, but very, some weird offshore plantation and things like that. But the key point here is that these proposals are just about transfers from one pension to another, which, while it has historically been a problem, it's much less of a problem now than it was 5-6 years ago or something like that, because of the pension freedoms being introduced. So that's the first. I guess not first note of caution in that this isn't going to radically dent the new forms of scam activity that we're seeing. The second point, and this is perhaps something we're only going to really see when these proposals are in place, but the danger here is that depending on how these questions are framed and depending on how stringent the DWP is in setting rules around the type of questions that providers need to ask, there's a danger that transfers to legitimate schemes will be held up. So when you think about the pensions cold calling ban, to me that was a no-brainer, because you weren't stopping any activity that you want to see from the industry. To my mind, there was never a reason why a pension provider should just be calling somebody out of the blue. So banning it, there was no consumer detriment as a result of that. So it seemed like an obvious good thing, albeit only stops one avenue that scammers can go down. Whereas with this, depending on how the questions are designed, depending how it works in practicality, the danger is that transfers between pension schemes, which are already often slower than they should be, will be slowed down even more. Now, I've transferred pensions from one provider to another, and I've had horrific times doing it. Sometimes I think the average transfer time is in the weeks, but there are cases where it can take longer than that, and even weeks in a world of Monzo, where you expect to be able to do your banking in a second, is too long. And so I think it's just one. I know that this is something that officials are aware of and are cognizant of the danger of slowing down transfers, and I think it may just be something that when these proposals are implemented, we'll just have to keep an eye on. And if there is an uptick in the average transfer times taken, then it may be that it just needs to be reviewed, because we need to be making progress in the other direction on the time of pension transfers. And if they were starting to slow down, then that would be a bad thing.
Interesting stuff. Okay, finally, Tom, I just want to go to the age when you can take your pension, right? And the data generally shows that about 3 times as many people tend to opt for drawdown than taking an annuity when they reach retirement age. But of course, when you're just, managing your own future, your retirement future, and how you're going to fund that through your pension, it can be quite fraught with difficulty trying to figure that out. Giving yourself too much income and then therefore running out of money, or in reverse, not spending enough and leaving a big pot after you pass. So those are the 2 problems that people generally face. But there's a new tool, the investment pathway tool, that's gone live. What is this, and how is it designed to help?
So yeah, the FCA's concern. So this is introduced by the Financial Conduct Authority and the city regulator in February, after a reasonable amount of consultation. So their concern is that people are holding cash as an investment for too long. And so clearly the danger, if you hold cash as a long-term investment in your pension, and when I say long-term, I'm talking about 10 years plus, it will be eroded away by inflation. So as a solution to this, the FCA have introduced investment pathways. So the providers are now required to nudge people towards investment pathway solutions, which are based on 4 broad outcomes. So I should say this only affects non-advised investors, who are in drawdown, who are entering drawdown or transferring to a new drawdown account, so keeping their money invested while taking an income via the drawdown route. The pathways that people will be offered are based around 4 broad objectives. This is one of the issues with pathways, which I can get onto. So the first option being, I have no plans to touch my money in the next 5 years. The second option being, I plan to use my money to set up a guaranteed income, so an annuity within the next 5 years. The third option being, I plan to start taking my money as a long-term income within the next 5 years. And the fourth option being, I plan to take out all my money within the next 5 years. So someone who chooses to go down the pathways route, when it's offered to them, will be offered those options. They'll then pick an option that best meets what they plan to do with their income. They'll then be offered a fund that's based around that very broad aim. So 2 issues that people need to think about when they get to the point when they're being offered a pathways investment, either by going into drawdown for the first time or transferring to a drawdown account for the first time. So firstly, these funds are based on 4 broad objectives, 4 broad outcomes. They have no bearing on the individual's risk tolerance. So if you're an investor who wants to take a bit more risk, then no questions have been asked of you in regards to that. So this fund will have to be very broad, and it won't be tailored to your individual risk profile, whether you're a high risk investor, a low risk investor, or somewhere in between. Secondly, and probably most importantly, that pathways won't act as a replacement for engagement or advice in drawdown. You mentioned in your question there the importance of a sustainable withdrawal strategy and making sure that you're withdrawing the right amount. So not just make sure you're not withdrawing too much too soon. Equally, making sure that you're not being overly frugal and not having the retirement lifestyle you should be enjoying, and end up leaving money behind that you weren't planning to do. Investment pathways don't do anything for your withdrawal, so it's still up to you to come up with a withdrawal strategy, however you invest your money, and it's still important that you engage and review your withdrawal strategy regularly, and also it'll be important to review the investments that you're in as well. So if you may go into drawdown and choose a pathway based on the fact that you have no plans to touch your money in the next 5 years, your plans may then change, and you may then decide that actually you do need to touch your money because you've got a relative perhaps who needs some extra cash, or you want to do it in your kitchen, or whatever happens. You may decide that you actually need to be accessing your money quicker, and if you're in that position, you might find that the investments that you're in. So if you've told your provider you have no plans to touch your money for the next 5 years, you'll probably be in a higher risk portfolio, something that's more invested in equities than you'd want to be if you're going to be accessing your money within that next 5 years. So if your circumstances change, then you may need to change your investments. You may also need to change your withdrawal strategy and all that kind of stuff as well. So it's a kind of nudge in the right direction. Which I don't isn't necessarily a bad thing, but investors just need to be careful and mindful of the fact that there's no investment solution that exists that means you can just go into drawdown and be done with it. You have to engage. You have to engage with your investments. You have to engage with your withdrawal strategy. You have to think about what you're doing in order to make sure you get the most out of drawdown. This isn't something that you can just set and forget and everything's going to be fine, because if markets change, then a withdrawal strategy that looks sustainable can quickly become unsustainable. Equally, as you say, if you're taking too little out, then you may end up not enjoying the retirement lifestyle that you could be. And after all, that is the whole point of saving up a retirement pot, is to enjoy life in your later years, and you shouldn't be scrimping and scraping when you don't necessarily need to.
Tom Selby, thank you very much.
Thanks.
Well, that was a great interview, very illuminating as ever with Tom. And the scam thing, I mean, it is frightening, isn't it? Just how devious some of these guys are.
Yeah, scams are pretty terrifying. Imagine if your entire pot was drained in that way. Pensions is a big topic, and it's very important. As I mentioned in my interview, it's one of the major ways in which we invest, especially with auto-enrollment tipping people into it as well. If you want to learn more, we have a previous pod from last year with Tom that is pretty comprehensive. It's about an hour long, and it takes you through all the different types. What do we mean by a defined contribution or a defined benefit scheme, all that kind of stuff. So please have a look at that if you're interested.
Okay, well, that rounds off the show for another week. Thanks to Tom from AJ Bell, and of course, thank you for listening. Join us again next week. Until then, it's goodbye from us. Goodbye.
Goodbye.